Did you know that in the early 1980s, Latin America's external debt grew to an astounding $360 billion, which was 3 times more than it was just 5 years prior? The scale of this debt was so colossal it's nearly impossible to fully grasp. It wasn't just a number on a balance sheet. It was a ticking time bomb, ready to explode and destabilize economies across the globe. As the debt mounted, so did the economic pressures within these nations. The impact was not limited to the financial sector. It trickled down to the everyday lives of people, altering the social fabric of entire nations. The aftershocks of this crisis were felt far and wide, leading to economic turmoil and political instability. The Latin American debt crisis was not just a financial catastrophe, it was a disaster that sent shockwaves through the global economy. The roots of the crisis can be traced back to the 1970s, when Latin American countries started borrowing heavily from international banks. So why did these nations plunge headlong into such a precarious financial situation? Well, the answer lies in a mix of economic conditions, banking practices, and government policies. During the 1970s, Latin America was brimming with potential. A surge in commodity prices led to a boom in exports, and the region seemed to be on the brink of unprecedented growth. International banks, flush with cash from oil-rich nations, were eager to lend. They saw Latin America as a promising investment and offered loans at attractive rates. Meanwhile, the governments in Latin America, buoyed by this optimism, began to borrow extensively. They had grand visions of modernizing their economies and improving the lives of their citizens. However, their plans relied heavily on external debt, and this is where things started to go wrong. When commodity prices crashed in the early 1980s, export revenues plummeted. Suddenly, these nations found themselves unable to repay their massive debts. At the same time, interest rates globally began to rise, making their debt even more expensive. The banks, realizing the risk, started to pull back. They tightened their lending policies, making it even more difficult for these countries to refinance their debt. The Latin American debt crisis was a complex event with many contributing factors, but at its core it was a crisis of debt and mismanagement. The effects of the Latin American debt crisis were not confined to the countries that were directly involved. In fact, it had a domino effect, impacting economies worldwide. Imagine a row of dominoes neatly arranged. With the slightest nudge, the first domino falls, triggering a chain reaction that topples the rest. This is how the Latin American debt crisis unfolded, its repercussions rippling across the globe. It's essential to realize that the global economy is a complex, intertwined network. Economic events occurring in one part of the world can have profound effects on other regions, even if they seem far removed. The Latin American debt crisis is a prime example. When the Latin American countries defaulted on their debt, it didn't just affect them. The banks that lent them money, primarily based in the United States and Europe, suddenly found themselves with significant losses. This led to a tightening of credit affecting businesses and consumers worldwide. Moreover, the crisis disrupted international trade. Latin America, a significant exporter of goods, suddenly found itself unable to pay for imports. This led to a drop in demand for products from other countries, affecting their economies as well. In the end, the crisis served as a stark reminder of the interconnectedness of our global economy. It showed us that a financial crisis in one part of the world can trigger a domino effect, toppling economies in its path. The Latin American debt crisis was a stark reminder of the interconnectedness of our global economy. So, what can we learn from the Latin American debt crisis? In essence, it's a stark reminder of the perils of economic mismanagement and excessive foreign debt. The crisis wasn't just a random event. It was the result of years of unsustainable policies and over-reliance on external borrowing. In a nutshell, the domino effect unfolded when one country after another defaulted on their debt, creating a ripple effect that shook the entire region. The crisis underscores the importance of prudent economic policies, fiscal discipline, and a balanced approach to borrowing. Fast forward to today, these lessons resonate more than ever. In a world increasingly interconnected, the ripple effects of one nation's economic decisions can have far-reaching implications. We must be vigilant and proactive, learning from the past to better navigate the economic landscape of the future. Remember, history has a way of repeating itself. By understanding the past, we can better navigate the future. If you found this video informative, don't forget to like, share, and subscribe to our channel for more insightful content on financial history.